Hey, what's up, everybody? It's Matthew. I am just coming to you guys on a late night just to go over a subject that's kind of on my mind. Today is Wednesday, June 15th, 2022, and we got some really interesting news from the Fed earlier today about a 75 basis point jump. Now, economic lesson 101. Basis point is literally an economic term generally used and expressed when talking about interest rate increases. And a basis point is basically 0.01%. So if I say 50 basis points, I'm literally saying 0.50%. So the decision today was an interest rate increase of 75 basis points. This is a 0.75 or 3/4 of a percentage increase to the federal funds rate. This is a rate that's controlled by the central bank. And what this does is it makes borrowing more expensive. So although many businesses can change their own rates, this makes it harder for them to get the money to loan to you for their benefit. So a lot of people look at this as like slowing growth. In a way, it kind of is. It makes it a little bit more expensive for you to get cheap credit and for businesses to get cheap capital in times like these. So this means that using your credit card will be more expensive. Getting a car loan, a mortgage, or a business loan will be a little bit more difficult during these times. This also affects jobs because when businesses expand and create new projects to embark in, they generally borrow because rates have been extremely low in the past few years. So now that interest rates are rising, that means more businesses must use operating income, profits, or cash on hand, which in this case is very difficult because many companies don't have excess reserves. So this means that businesses will contract instead of expand, and they will generally cut the excess in their organizations. So you're seeing a huge layoff in the tech industry, and that is happening. So this is all done to stop the flood of cheap credit and curb inflation. So the biggest thing that we're trying to combat right now is inflation, which is due to the fact that we've had cheap credit. National debt has gone higher and higher year after year, and not to mention the pandemic where stimulus checks were given out, money was printed at a very high rate, really fast to combat that economic situation. So this is all done to curb inflation, and it's really to increase the purchasing power of the dollar, which during inflation goes down, or in a sense, you can think of it as being diluted. So we're basically in a position which is very hard to think of. We have two options here. Option A is we continue with money printing and cheap money, and everything becomes more expensive with the risk of high inflation and potential hyperinflation down the road. So where the costs keep going up for everyone because debt is so cheap and you can just keep printing money, keep borrowing, keep going into debt, whether it be business or personal, that is going to create a snowball effect where you are basically going to have CPI increasing due to the fact that money is just printed and printed and printed. Now, I know a lot of people look at channels that talk about this or people that talk about this and think that it's fear mongering. But when you do look at the amount of printing that's gone on in the past few years, it's pretty crazy. So if we go with option A, that could lead to even higher prices across rent, oil, lumber, and everything else. Very few times have we had, incredible inflation like this. But if you look at countries like Venezuela or Zimbabwe in the past, they have gone through hyperinflation where, the amount of money needed to buy basic essential items like bread or milk or even rent or a car is incredibly expensive compared to the amount of, paper money that's needed. So you see a lot of pictures where people are holding up, barrels of money or, just huge amounts of money just for a loaf of bread. That is a case of hyperinflation. So what we're doing now is trying to increase the basis points little by little, and they're kind of gauging it as they go. So the Federal Reserve is not trying to throw us in a recession, but we're trying to combat this the best way that we can. Option B is increase the interest rates in small increments to tame the inflation. So that's what we're currently doing. We're increasing the purchasing power again. We're limiting the amount of excessive money printing or lending, and this will cause pain points. So right now you're seeing layoffs, and if the Fed isn't careful, this could really bring the country into a recession. We know that Q1 of 2022 was a negative GDP. So at the end of this month, when we get back the results of Q2, and if it's again negative, we will know for sure that we are in a recession. Basically we're at a point where we either, let the money keep printing and let debt be cheap and businesses just borrow, against, cheap lines of money, and personal debt accrues at an all-time high. Or we go with option B, and that is what we're doing now with the increase in rates. Now, it's coming at a very hard time because gasoline is at a all-time high, and oil, the war in Ukraine and Russia that's happening. There's a lot of uncertainty around the world, a lot of things such as violence and, gun violence that's going around in the country. So what a very interesting time that all of this is kind of going down, coming down to as far as the timing and the events of this. I basically use the analogy, we're basically ripping the Band-Aid off and letting it bleed. So if we didn't take this path and we didn't have a rise in interest rates and sort of bring society back to normal, there would have just been an ongoing sort of snowball effect with debt and inflation to where it would just be out of control. So there comes a point where the Federal Reserve has to make a decision and say, what are we going to do and when are we going to do this? The main thing for your everyday citizens is, if you're working, you're employed, you want to make sure that you're cutting some of your expenses. You want to be prepared for, that worst situation. You want to have a rainy day fund. I've talked about this on my channel quite often, but it's not talked about enough in society. In order to really, really get ahead, yes, you want to diversify your assets. It's a little risky in the time because generally when you hike up interest rates, the equities market, can tank. Crypto right now is going through some corrections itself, which I speak on a lot in this channel. So you just want to be more cautious. You want to have a little bit of liquidity in these kinds of situations. 3 to 6 months is generally a good rule of thumb as far as how much you should save and have enough to cover your rent and all of your expenses for 3 to 6 months. That's a good starting point. And, if things get better, and you're able to save more, so be it. I am coming to you as just a way of kind of expressing this and for a very sort of simple and easy to understand way of explaining the predicament that we're in. Again, this channel is not financial advice. I'm giving you opinions. I'm coming to you with things that I'm interested with and topics that I like to talk about that affect the general population. And I appreciate you. If you like this content, remember to like, share, subscribe.